Hello and welcome back to the Ducoscope studios here in Geneva. Joining me today is Sacha Duparc from BCV. So Sacha, welcome to the studios.
Thank you for having me here today, Jessica.
So today we'll be discussing systematic risks and portfolio hedging solutions. So starting off, what methodologies do investors typically consider when building resistant long-term portfolios?
Well, most investors are looking for the highest performance per unit of risk when putting together assets. And they're also looking at what the correlation is between all these different assets. So it's an exercise where basically you sort out whatever asset has the highest performance for the lowest possible amount of risk. And the idea is to combine them so that you have the most efficient portfolio. Now, after the 2001 and 2008 market events, people are also looking at other methodologies whereby they focus more on drawdown risks. Especially in these times of market crisis, they want to see what is the impact of those drawdowns on these potential asset classes that they're considering.
So what type of risks can these severe historical portfolio drawdowns be attributed to?
Well, we found out that diversification is very much a myth. If you look at the 60-40 portfolio, therefore a portfolio composed at 60% of equities and 40% of fixed income, 90% of the variance of those portfolios come from the equity risk component. And so we have to understand what this equity risk is really about. And people have found out that it's whether a shift in expectations in terms of economic growth going forward, therefore affecting the net present value of pretty much all assets, all risky assets, or it's a change in the risk aversion parameter of most investors. Therefore, if you have a higher risk aversion parameter, pretty much all risk premia or all risky assets need to have their expected returns go up to compensate for the additional risk.
So how could investors think about mitigating the equity risk of their investment portfolios?
Well, what we've been looking at really is to take different pairs of assets. So we're looking at the S&P 500 and we're looking at an alternative asset. And we're building portfolios of those two assets and looking for the combination or the allocation that's required to lower the portfolio tail risk by 25%. And we think it's a good approach so that we can compare each and every alternative assets on an equal footing. Why is it that we think this way? Is because those assets that have low correlation to equities usually have negative or low risk premia attached to them. Therefore, we don't want to have a high opportunity cost of holding this asset for a very long time.
So what investment strategies have actually performed best during extreme market events?
Well, our analysis has shown that first and foremost, when there's a liquidation, people go directly to cash. So our benchmark is really cash. We want to find out those assets that have performed better than cash during these extreme market events. And we found out that there are actually a few, to our surprise. Well, some are not that surprising, such as hedge funds that are called short systematic bias, or that have a systematic short bias on the equity market. But we've also found a whole array of option-based strategies, such as iron butterflies or iron condors. And a third asset class would be simply corporate bonds and government bonds. But we have to look at multiple criteria to really find out which is the best asset. And just to look at the performance of those assets during these periods of crisis is not enough.
So beyond performance and certainty of performance measures, what other metrics are also considered?
Well, we thought about the whole array, a whole array of metrics. And what we thought was most interesting was to look at the certainty of having this insurance, so to speak, during these times of market events. In this regards, there were multiple assets that performed just as well as cash, or even better in terms of performance. We're thinking again about these hedge fund strategies that have this negative or this short bias on the market. But again, those also option-based strategies have performed tremendously well. If you look at all the short Vega strategies, are rather interesting because it's really not something you would think about in the first place. But when implemented in a systematic fashion, basically you manage to harvest these higher volatility premiums in the market when the market is going down. So it gives you a buffer against those drawdown losses. So we found out that basically there's not one ultimate solution. There's not one asset class that's really so much better than cash that you would immediately go to this one solution when the market's correct. But you have to set up a whole array of different criteria that correspond to your objectives. And once you've defined those criteria, you can select those assets that best fit your needs.
Absolutely. Well, Sacha, thank you so much for coming in today and sharing your expertise with us.
Thank you, Jessica, for having me here today.
And thank you for watching. For all the latest Dukascopy updates and interviews, do keep clicking back. Goodbye for now.